Welcome to The Explainer. Today, we're going to talk about one of the biggest things that holds people back from investing, just plain old fear. And we're going to look at a really powerful strategy to fight it. It's called dollar cost averaging, and it's all about building wealth with discipline, not trying to guess the future. So, let's just dive right in with the question that I think every single investor asks themselves. The one that can cause a ton of stress and keep you on the sidelines. When is the perfect time to jump into the market? I mean, that fear is real, right? The nightmare of putting all your savings into the market on a Tuesday only to watch it completely tank on Wednesday, that thought alone is enough to paralyze anyone. And what does that fear create? Well, it creates what's known as the market timing trap. It's this endless chase, this belief that you can perfectly buy at the absolute bottom and sell at the absolute top. But let's be real, it's a game that even the smartest people on Wall Street almost never win. But what if there was a way to just sidestep that whole trap? A simple, almost mechanical strategy that takes all the emotion and all that stressful guesswork completely out of the picture. What if we could just put our investing on autopilot? We'll say hello to dollar cost averaging. The idea here isn't to be some kind of market wizard. It's just about being disciplined. You simply decide you're going to invest a fixed amount of money, let's say $100, on a regular schedule, maybe the first of every month. And you do it no matter what the market's doing. High, low, sideways, it doesn't matter. Okay, so check out how this actually works. Your $100 buys you 10 shares when the price is $10. Simple enough. But look what happens next month when the price drops to $8. That same $100 now gets you 12.5 shares. And when the price shoots up, you buy fewer. See what's happening? You automatically buy more when things are cheap and less when they're expensive. And here's where it gets really interesting. This is kind of the magic of the math. After those 4 months, your average cost for each share you bought is $9.61. But the average price of the stock during that time was actually higher, at $9.87. So you ended up paying less per share than the average market price. That's the built-in advantage. Now, the math here is pretty solid, but this brings us to a huge debate in the investing world. Is dollar cost averaging really the best strategy out there, or is it just the one that makes us feel better? The classic battle of your head versus your heart. So your logical brain, the head, looks at the historical data, and since the market tends to go up over the long run, the numbers show that investing a big chunk of money all at once, a lump sum, actually leads to higher returns about 2/3 of the time. Why? Well, just because your money is in the market, working for you for a longer period of time. But then there's your heart, right? Our emotional human side. When the market is crashing, our gut instinct is to panic and sell everything. Dollar cost averaging acts like a behavioral shield. It's on autopilot, so it forces you to keep buying when prices are down, which perfectly sets you up for the big gains when the market recovers. It basically protects you from yourself. And because it's such a great psychological tool, this strategy is probably already a way bigger part of your life than you even realize. It's really the foundation of how most of us save for the long term. I mean, think about it. If you have a 401k at work and money comes out of every paycheck to buy into your funds, you're using dollar cost averaging. If you set up an automatic monthly transfer to an index fund, yep, that's DCA too. It's the quiet little engine that builds wealth for millions of people. And its power really shines when you look at super volatile markets. Take something like cryptocurrency with those insane price swings. Trying to time that market is a recipe for a heart attack. DCA gives you a sane, rational way to get involved without all that stress. It's an anchor in a storm. So what's the big takeaway here? Well, it all comes down to the core philosophy behind this whole approach. It's a huge mental shift, moving away from chasing perfection and instead embracing consistency. And that really reveals the true purpose of dollar cost averaging. The goal isn't to get the absolute highest returns possible. No, the goal is to manage the single biggest risk in investing, your own emotions. It's designed to maximize the chances that you'll actually stick with your plan for the long run by making discipline pretty much effortless. So we'll just leave you with this one question to think about. What's actually more valuable? A theoretically perfect strategy that you're just going to abandon the second things get scary, or a pretty good strategy that you can actually follow for a lifetime? Because in the long run, consistency, well, it isn't just a strategy, it's a superpower.